The role that bonds play in a portfolio is they act as a diversification away from equities. And where our fund is quite unique is many buyers of fixed income don't quite appreciate that they're buying quite a lot of equity beta within that. So i.e. in a risk-off scenario, those funds will struggle. How we like to position our fund with a defensive starting point, a focus on liquidity and quality, really acts as that role as a diversifier. In terms of the valuation backdrop and the yields on offer, whilst we're not quite at those 2022, 2023 levels of yields, they're actually very attractive from a post-GFC perspective. So as a starting point, whilst there's going to be some volatility ahead, that is inevitable. Yields are still attractive, which really does act as a buffer to total returns. Interestingly and mistakenly, Fidelity are often known as just an equity house, and that doesn't really tell the full picture. We've been managing fixed income for 35 years, and within those 35 years, we've been managing global bonds for the vast majority of that time. What sets us apart is we have a unique and dynamic investment process where we take high conviction bets. Often the portfolio has around 100 to 200 names within that. And we often start from a defensive starting point. So we like to be a buyer of risk when others are maybe a false seller of that in a risk-off move. And actually, interestingly, we leverage on the resources of the equity platform, which is quite helpful for the portfolio management team in identifying turning points. And often you'll see there'll be a different conversation between a credit analyst and an equity analyst with issuers management, and that is really valuable. Fidelity's approach to global fixed income is unique in the sense that we have an active, highly nimble and often contrarian approach. So we have a very high turnover in our portfolios of around 200 to 400%, which is unlike many of our competitors. We buy names within the portfolio where we see that they're attractively priced and we see a spread tightening event in 3 to 6 months, which is very different to many of our peers that are quite often just focused on building a portfolio with a higher carry. So our track records in fixed income are particularly compelling. If you look on an excess return basis over many tenures, they're in positive ground. I think also what really sets us apart, and we've touched on this a little bit briefly, is that defensive starting point. So often what you see in really challenging market conditions is the fund performing quite well. So let's take 2020 as an example. That was actually one of the best years on record for the lead portfolio manager of this strategy, which is a real testament to our investment process. So in regards to how we're managing risk in the portfolio currently, obviously we've touched on that defensive starting point, but we're rather defensively positioned. Obviously there's many unknowns ahead, and that is how we feel is the way to position going forward. So that comes from a long duration bias, slightly underweight in credit. But if we talk more broadly about how we manage risk in the portfolio, quite often the question that we receive from clients is, how do you approach high yield investing? And it's a little bit of a grey area. Many of our competitor funds are quite aggressive in that space. To be transparent, we are not. So we do have high yield in the fund. It's typically up to 10%, but I need to give a few strong caveats behind that. For a high yield name to be within the portfolio, it has to be BB+ or BB from a developed market, non-cyclical issuer. We're not chasing EM risk in the high yield space. We're not going to be one of the more punchy funds out there. We are a do what it says on the tin and do it well kind of approach.